This is the Friday, March 24th, 2017 version of the Market Plus segment. Joining us now is Chris Robinson. Chris, welcome back.
Good to see you.
Hey, we're really glad to have you here. Thanks for making the time to come in almost last minute and step up. I thought that was a good conversation during the show.
Well, thank you. Yeah, it was my pleasure.
But we're not done yet.
Okay.
We're not getting you out of that seat quite yet. We did not get a chance to discuss the cotton market. It was another one of those markets in the red on the week. Have we flipped that over? Are we moving back into a downtrend in cotton?
I would be careful to call it top in cotton.
Okay.
It's been on a really good move for quite some time. Beginning of the year, you saw a big move, and now the managed funds own it. Okay. They're long about 110,000 contracts, which is half the crop. So you saw a big move at the beginning of the year. They bought all commodities, all physical commodities, trying to get ahead of this inflationary idea. Some of them have paid off better than others. You know, they were long soybeans. Now they've just probably gotten flat soybeans. They lost money being long crude oil, but they've made money being long cattle. They've made money being long cotton. They've made money being long, believe it or not, copper. You know, so, and that's all this is. These guys make a blanket bet. So I think fundamentals are running secondary to anything else. Right now, they're your friend. And look at where we were, you know, a year and a half ago, down below 55 cents. Guys saying, you know, what am I even doing this for? Mm-hmm. So now we're approaching most guys at 77 to 80 cents. It's profitable. It's actually profitable enough even if you set a hedge right now. There are some good hedges out there where you can go, not spend a whole lot of money and protect, because when it does correct, and it will, if I knew where it was going to correct, I wouldn't be sitting here, you know. But typically we see that the market climbs up the escalator and it corrects down the elevator shaft. So it may correct. It's probably going to be something that nobody expects. Why did they'll be like, why did that happen? So if I'm a cotton producer, I'm just happy right now that it's going my way. Yep. And I would not do anything to lock out the upside, because it could have a lot more to run. Okay. It's very sensitive to China. China's the biggest producer and the biggest end user. And I think, again, this may have been some concern about us getting into some sort of a trade issue with China that hasn't developed yet. And, you know, so for now, I think that if I'm a cotton producer, I'm just setting my hedges and I'm not getting over aggressive getting sold.
Yeah, close the week at 77.47 on the nearby. Yeah, you're right. I mean, there's some pricing in there to buy a put. Cover yourself. Are we expecting any big news on cotton from the acreage report next Friday?
Not really, but you may see, I mean, now, again, with where soybeans were, and now you may see some makers move actually towards cotton, and that would be the kind of this, you know, surprise. Yeah. But at the end of the day, the market's well supplied, the demand's good. We have better quality than China. That was the real issue, too. China has got a lot of cotton stored, but they haven't taken care of it. So when they want quality cotton, they've been quietly coming here. And hopefully that continues. Yeah,
hopefully it does. Now, we talked about on the show the Brazilian beef issue really moving the live cattle market higher. We've seen feeder cattle follow along very, very nicely. But we're in an environment where the cash fat cattle are trading higher than the feeder cattle futures.
Yeah, that basis is out of whack.
It's way out of whack. Is that going to help? Are we going to have cattle feeders with money spilling out of their pockets for the first time in 2 years run this feeder cattle market higher?
Well, it just depends on, I think, this Brazilian thing. If it continues to go, again, it's not a freight train I want to step in front of. A lot of our guys use puts. Some of my guys trade the board. It's no fun when you have to send in all that money every week or every day. Need some more money. So I think that this was a surprise move. My guess is, I've been doing this long enough that when it turns, that'll be a surprise as well. The rubber band can only stretch so far. But again, can it continue to go higher? Yeah. I mean, the same people that are telling me that it can't go higher are the guys that told me that we'd never go below 150 feeders back in the, you know, a year and a half ago, 2 years ago. Yeah. So I stay away from doing that. I've been doing this long enough to know that, you know, if you're a cattle rancher, you're long. Right. You know, enjoy the fact that you're long and you're making money. Don't get in a situation where you're hurting yourself trying to be a hero, because at the end of the day, you know, you're making money. And look where we were 6-7 months ago. A lot of depressed guys. Yeah. We had fat cattle under the buck. Yep. And the guys talking about going back down to 80, 70. And, you know, so this is a gift. Okay. So you don't look a gift horse in the mouth. You protect against it. And I hope it keeps going. I hope that every time we set a hedge, we go higher. Yep.
Now, you talked about the managed money has been a huge player in the live cattle market. Have they also been buyers in feeder cattle?
Not as much. Their
Okay.
big play has been in the fat cattle, live cattle.
Gotcha.
Long over 110,000 contracts there, and we'll see if that continues. Again, these guys are your best friend when they're betting with you, but when they decided to head for the hills, look what happened in soybeans.
Yep.
You know, they're there till they're gone, and unless we get a weather issue or something like that, and again, that's all tied up right now. If you're a cattle producer, you've got cheap corn. I don't know why you wouldn't be going out and taking upside protection just in case. What if corn rallies $1.50? You don't want to be looking back saying, oh, we could have protected. You can buy $4 July call corn for 6-7 cents.
Yeah, and that's actually, that leads us right into our next question.
Yeah.
So Matt in Jones County has listed off. We saw 370 old corn. We saw new crop at 395, beans at 1040, new crop beans at 1012, milk was at 17 bucks. He wants to know, are those numbers all gone? Are they all in the rearview mirror now?
Well, we don't know. You know, nobody does. I will say this, especially, I like to take the forest for the trees look. If you look at cattle, and the cattle's on making contract highs, so that's kind of different. That's in a separate pile. But take a look at soybeans. You look at new crop soybeans specifically. The low in August was like 903. The high in November, when the Chinese were buying all the beans, was 1040. Okay, so that's a $1.40 move. Today's low, 70 cents back. We're sitting dead right in the middle. Yeah. So we're halfway back. So you tell me, are we going to get a weather story and go back up, or are we going to fall apart and see $7 beans like everybody told me we were going to see last year?
Right.
So I don't know. Right now, the market's giving you an opportunity. You talked about dairy. You know, it took forever for dairy to get back up to 17, 18 bucks. A lot of guys were waiting to hedge because they wanted to see 20. Lo and behold, we had this, you know, it took 8 months to rally up. It took about a month and a half to correct. Okay. So it looks like we've got some support in milk at 15. So I would base it from there. I'd say, okay, worst case scenario, let's protect 15, 16. And, you know, if you're aggressive, if you're selling it and you're worried that it's going to rally back up to 18, there are strategies to re-own it. You know, you don't have to re-own it on the board if you don't want to, but you can go out and buy some 18-cent calls.
Yep.
And then that way you sleep at night. You're not going to be kicking yourself if we do get that milk back up to 20.
Right. China steps in and starts buying powder, and it goes nuts.
Absolutely. Maybe they say,
Yeah.
The U.S. is our best friend.
Right. You never know where these things can go. So now we've talked about 2017 prices. We've got a question here from Michael in Roland, and he's got a very long question. I think we've addressed a lot of it. But at the end of the day, where should the producer be looking to price in some options, to get some hedges on, and to make some cash sales? What kind of targets do you have in mind price-wise? Do you like going ahead and locking in where we're at today with a hedge?
For corn or beans?
For beans.
Soybeans,
beans.
I mean, soybeans even today, what do we settle, 975?
Yeah, right in there, 977 on the Novi crop.
Well, the market gave you ample opportunity to protect north of $10. We couldn't get through 1030 about 6 or 7 times. Our strategy, and the hindsight's always 2020.
Yes.
I'm not sitting there going, look at us, we're great. We made some cash sales when we were above 10 bucks. Our guys are about 20% sold at guaranteed bushels. Okay. Don't let profitability fall away. So yeah, if this is profitable for you and you're worried, oh my God, what would happen if soybeans break down to $9? Mm-hmm. There's still 75 cents worth of risk there. So do the math. What are you willing to spend to protect that 75 cents? And with these shorter dated options now, you can do an option, a new crop November option, which is May dated.
Yep.
It'll protect you through the report, which is this week, and then 3 weeks after. And then you can look and see what level do you want to protect. For me, with 75 cents worth of risk, I don't want to spend more than 10 or 12 or 13 cents just from risk reward. You don't want to spend 30 cents to protect 70. Right? I like those shorter dated options because they let you spend less money while keeping the upside open. In years past, you'd have to gone out and bought 200 days worth of time with a Novi. If you want to do that, if it fits in with your plan, fine, go ahead. But I would say this, if you're selling anything, I think you owe it to yourself to re-own at least half.
Okay.
Be half right, half wrong, because if we do get a weather issue this year, I mean, I don't know, you don't know, nobody knows.
No.
If we get a weather issue, you don't want to be looking where you've sold beans today at $10 on the board, say, or $9.75. You don't want to be watching $12.75, $13.75 beans, and you're pounding the table.
Yes.
So there are ways to do it. There are ways to do it where you can limit your risk and keep your reward wayside open. The only problem is, and this is why people don't like to hedge, there's no guarantees, because if there was a guarantee, we'd all just be virtual farmers, right?
Yes.
We would just trade and sit on the beach.
Yes, everything would be fun.
Right.
Now, Phil from Ontario, Canada, had asked a question. He wants to know about soybean prices as well. I think we've covered them pretty darn well here in this show.
Okay.
But I wanted to ask you, we did see continued or a little bit of continued weakness in the U.S. dollar this week. What's the trend in your eyes as we look out here? You know, take us through the report on into, let's see, when does the Fed meet again? Well, next April, I suppose.
Yeah, next April.
Yeah.
Well, that's interesting. The Fed pretty much told us in December that they're going to continue to raise rates. Okay, with a smile on her face, she sat there. We got used to a decade or maybe not quite a decade of no movement in the interest rates. So I think that's baked in, whether they do a quarter point or not, but they definitely want to do it. And let's face it, I mean, they're raising rates, and so far we're holding them there pretty good. The stock market hasn't taken a big swan dive. The U.S. dollar continues to be pretty well supported. Now, we had a big move really starting last May. If you look at the charts, and you can pull that up and look and see, you pulled up a dollar index chart. We topped out after the election.
Yep.
The idea being that U.S. dollar is going to continue to get stronger. We've had a little bit of a correction. A lot of people like to trade around the psychological number of 100, which is par.
Yep.
Okay, so right now we're bouncing over par. I think that the trend is still up. My experience with doing this for the last 30 years is that big trends like that, they're kind of like battleships and like an aircraft carrier group. They don't turn on a dime. It's not a jet ski.
Okay.
So the trend continues to be higher. I mean, we could have continued weakness in the dollar and still be in a pretty good uptrend. So there may be some backfilling yet to go.
Okay.
But at the end of the day, I think that big theme is still strong U.S. dollar. And again, we'll see what happens with the Trump administration. If they can get a tax reform thing through, that'll be huge, because that's what everybody's really waiting for.
All right. Now, our final question, Kristen, since this is our first time, your first time on the show with us, what we usually do is we like to ask our analysts to help define terms that get spoken repeatedly in the commodities trade. And we were going to ask you to define what is a trailing stop. What does that mean?
Okay. A trailing stop. There's two ways to do it. Either you've bet long or you bet short. We'll start with the betting long, because most producers, you're net long speculators. You're long all the beans and corn that you've got stored, all the beans you're going to plant for the next 20, 30 years. You're always long.
Yep.
So the way people would use a trailing stop is if you're trading on the board, and suppose today you bought beans at $9.75 because you think that this is a level I want to own them. You're speculating. You don't want to be in a situation where you're long beans from $9.75 and you watch them go to $9, right? So a trailing stop is very simply, you can say, all right, I'm willing to lose 10 cents. So you're long at $9.75, you put a trailing stop at $9.65. And then you leave it good till cancel. It works 24 hours a day when you're asleep, when you're awake. Then, hopefully beans go to $10 again. You can say, hey, we just made 25 cents. I'm going to move my stop up now. And now, since I'm long from $9.75, let's make sure that I guarantee I'm going to always be long at $9.85. I'm always going to cover that. So then the market can continue to go higher. So it lets you ratchet up so as the market goes higher, because sooner or later the market will correct, and you want to be in a situation where you've let a potential winning trade turn into a losing trade. So it's just basic 101 risk management for trading, and it's something I think that if you want to educate yourself, look that up. But at the end of the day, that's what it is. It's a mechanical way for you to lock in your risk and sleep at night and know that, you know what, I can go to bed at night and beans aren't going to be down and I'm hurt.
Right. I don't wake up in the morning with a margin call from my broker.
Right.
All right, Chris. Well, hey, thank you so much for taking the time to be with us. Really do appreciate it.
All right. It was a pleasure.
Join us again next week when we convene a roundtable to break down the significant government reports and their impact. Until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.